Ladies and gentlemen, good day and welcome to Aarti Industries Limited Q3FY22 Earnings Conference Call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Shiv Mattu from CDR India. Thank you and over to you.
Yeah, thanks, Stanford. Good evening, everyone. Thank you for joining us on the Aarti Industries Q3 FY22 Earnings Conference Call. We have with us today on this call Mr. Rajendra Gogri, Chairman and Managing Director of the company, Mr. Rashesh Gogri, Vice Chairman and Managing Director, and Mr. Chetan Gandhi, CFO of the company. Before we begin the call, I would like to point out that some of the statements made in today's call may be forward-looking in nature, and a disclaimer to this effect is included in the results presentation shared with you. I would now like to invite Mr. Rajendra Gogri to take you through the performance of the company and his outlook on the business. We will then open the forum for Q&A. Over to you, sir.
Thank you. Good evening and very welcome to all of you attending this call. I hope all of you and your families are in good health. I trust that all of you would have received Q3 FY22 results presentation and uploaded on the stock exchange website earlier. First, a review of our financial performance. Based on the financial results of the year till date, we have delivered performance that reflects the strong business traction across both our verticals and position us to comfortably exceed our growth guidance as shared earlier this year. Our Q3 revenues were at the 2,636 crore. This includes the termination fee in respect of the first long-term contract to the tune of rupees 631 crore. As you would recollect, in the month of June 20, we had received the notice of termination of this contract from the customer. Appropriate disclosure related to same were given immediately to the stock exchange on June 15, 2020. This has resulted in increase in EBITDA and PBT by rupees 611 crores, net of currency mark-to-market and expenses. Excluding termination fees, our Q3 revenues were rupees 2,005 crores, up 53% year-on-year. Revenue expansion during the quarter also includes the pass-through of the substantial increase in raw material prices, as well as fuel and logistic costs to our customer based on the contractual terms. We continue to extend the growth momentum by engaging strong customer traction for our expanded manufacturing capacity across key product lines. As discussed in the past, our reported EBITDA is the key monitorable data point as it neutralizes the input cost variation. During Q3, our core EBITDA at rupees 356 crore, netting off for termination fee, is once again the highest in our operating history, demonstrating the ability of the business to maintain margins by passing on to customers the food cost inflation experienced during the reported period. Q3 EBITDA was also higher by 25% YOY. EBITDA growth was driven by higher capacity utilization, volume growth, favorable product mix and realization. Our profit before tax came in at rupees 247 crore after adjusting for the termination fee. This is up 18% YOY over Q3 FY21, is also our highest ever profit historically. In the specialty chemical business, our core revenue without termination income came in at rupees 1,657 crore, up 56% YOY. Segment EBITDA at rupees 284 crore net of termination income for Q3 translates into growth about 27% on YOY basis and about 17% higher on QOQ basis. As you are aware, we have a pricing model where the variation in input costs such as raw material, fuel, logistics, etc. are passed on to the customers, and growth achieved on this parameter during Q3 indicates positive momentum in the business. This is in the middle of continuing rise in the price of various key input commodities, fuel prices, and significant high cost of logistics. We are watching the situation closely and continue to pass on the impact to the customer to the maximum extent possible. There are instances where we have to absorb some part of this. The current inflationary trend has also resulted in increasing working capital, but our well-capitalized balance sheet has enabled us to manage the situation well. We saw a return of demand from established market driving improved margins. During the quarter, shortage in the supply of nitric acid impacted volumes of nitric-based products. Now for the Q3 production update, production for nitrochlorobenzene was about 18,504 metric tons compared to 16,832 metric tons a year back and about to 20,347 for Q2 FY22. Similarly, for hydrogenated products, we have achieved production of 2,878 metric ton compared to 2,739 metric ton last year. On the nitrotoluene front, the production for Q3 was 3,633 metric ton compared to 3,594 metric ton in the same quarter last year. During the quarter, the shortage in the supply of nitric acid, which is one of the key raw material, impacted the volume of nitric-based products. We are also witnessing the shortage in the current quarter for FY22 and are taking necessary steps to optimize the product mix. Coming to the key projects for the segment, we are currently taking trials of the project related to the second lung contract and expect to commercialize the unit in this quarter, that is Q4 FY22. The project is related for third long-term contract at Jagadia, the NCB capacity expansion of Vapi, expansion cum asset upgradation for our acid unit at Vapi, etc. are expected to come on stream in FY23. The commissioning and scale-up of these units and the recently commissioned facilities will drive our growth and enable us to meet the growth guidance for FY24 as given earlier. We witnessed the return of demand from established market driving improved margins. With a positive traction for the segment across for both Indian and global market, we expect to deliver steady performance improvement going forward as new facilities scale up volume. For Fajna, business grew 40% YOY to rupees 348 crore during Q3. Here too, we passed on higher cost to customer, resulting in top line expansion, where part of the fuel cost had to be absorbed by us. Business improvement has been driven by higher volumes, improving efficiency and entry into new APIs. We have established relationship with global generic pharma companies and continue to invest in the expansion of API and intermediate capacity. We have now attained large scale in this segment and see further increase in volumes based on our new investments. Further business visibility in pharma is based on higher volume from regulated markets, value-added products, and new introduction of intermediate products. Currently, trials are being conducted in the new expanded block at the US FDA approved API facility located at Tarapur. We targeted commissioning in the current quarter itself, that is before the end of FY22. EBIT for the pharma segment for Q3 was higher by 10% year-on-year at rupees 60 crore. This was also a sharp increase of about 46% over the preceding quarter. That is over Q2. EBIT as specific issues witnessed previously are now largely resolved. Going forward, we expect volume expansion to be supported by robust margins in this business based on the pipeline of approvals across INT, hypertensive, cardiovascular, oncologies and corticosteroids. Now an update on capital expenditure. We have incurred capex of rupees 312 crores in the third quarter. We have now invested about rupees 920 crores in the year to date and expect the annual capex to be around rupees 1200 to 1300 crores, which is within the range from with our earlier capex guidance of rupees 1200 to 1500 crores for FY22. As shared earlier, we are also undertaking various R&D and innovation-driven programs with 40+ products for chemicals and 50+ products in pharma in the pipeline. It will drive our growth beyond FY25 and give us a horizon value visibility till FY27. Now, with reference to the update in the proposed demerger of the pharma business and allied activities, we like to share that we have received the necessary principal approvals from Stock Exchange in the last quarter, and the application is now under process at NCLT. We expect the process for getting necessary approvals for the state scheme to take around another 4-5 months, which is in line with the overall timeline that we had shared earlier. Before I conclude, I would like to reiterate that we are focused on building an augmented organizational framework that positions us strongly to capture strategic growth opportunities in our focus verticals. We have an expanded pipeline of projects currently underway, providing clear visibility to the business over the next several years. As India emerges as an increasingly significant global chemical supply destination, backed by supportive regulatory framework instituted by the government, our capex commitment driven by well-capitalized balance sheet will allow the pursuit of aggressive growth in line with the business blueprint. In addition, our plan to create individually focused business in our two core verticals will further enhance value of all our stakeholders. With that, I conclude my opening comments and we'll open the floor for the Q&A session. Thank you.
Anyone who wishes to ask questions, please press star, then 1. The first question is from the line of Surya Patra from Phillip Capital. Please go ahead.
Yeah, thanks for this opportunity, sir, and congratulations for the good set of numbers. Sir, the first question is on the terminal compensation that we have received. So obviously it was guided and in the similar lines only it has come. So it seems that we have got adequately compensated for the deal cancellation by the customer. But in this process of deal signing and cancellation and not getting real operational contribution from the transaction, so did we lose anything in the process, either in terms of our effort, time, and all that, which possibly we could have created something else? Hello.
Hello.
Hello. Can you hear me?
Yeah. Yes. No, basically now we'll be utilizing this facility for other customers as we had guided earlier. So, because the facility still remains with us, and I think overall, we have got this compensation, and as the facility will be also continue to be utilized, I think we are fairly okay.
Okay. On the financial terms, obviously it was better than a kind of compensation, expected compensation, but possibly you could have utilized our effort in a right direction and better direction. Is that the case?
Nobody had visualized this kind of a thing which will happen at that time. So the partner also had spent a lot of money. Yeah.
Sure, sir. Okay. My second question is on the margin profile, sir. So since last 6-7 quarter that we have been getting a $5 million kind of compensation amount that was getting built into our numbers. So that was to some extent supporting the margin, overall margin, reported margin at a time when there were challenges and all. So adjusted for that, I think the margin profile would be around 17-18%. That is at one end. And prior to that phase, our margin scenario used to be 20%. And we have now guided for a higher margin scenario for 25 to 30%. So how should one really bridge this equation from the current 18% to 25% plus kind of margin scenario going ahead beyond FY24? And in between, from current period to 24, what would really drive that, and what is the margin scenario should look like?
Yeah, actually, basically this quarter itself, this year the raw material prices substantially increased, if you see the last year. So margin profile becomes very difficult. But in general, the new products which are in pipeline, which are for which we'll start the construction of plant in FY23, they are more value added, so which will have a higher EBITDA margin at constant raw material prices. You are right regarding this 5 million which we used to get against this contract. That will definitely have a negative impact on margin. But longer term increase in margin is more on based on introducing a newer value added products.
Okay. And this crude price, which is now beyond $90 per barrel, whether that is a kind of a real concern at this junction, do you think, sir, or it is a kind of a temporary one, or even if it is not a temporary one, you can easily pass on the elevated cost? Is that your understanding?
Yeah. Generally, crude price, even at whether it's 90 or it goes 100, whatever. But we have inherently a raw material pass-through model, and we are able to pass on the price increases either in the same month or maybe in with a quarterly lag in general. So we are not much concerned on that.
This last question, sir, on the first contract, the plant relating to the first contract. So we were thinking to commercialize that adequately from third quarter. Whether we have seen any ramp up there, or when do you really expect that to happen?
Yeah, we already started selling the material from that plant, and it will be, I think, from FY23 we will see a substantial ramp up, and by FY24 we expect to almost reach our targeted original volumes.
Sure. Okay. Thank you, sir. Thanks a lot.
Thank you. The next question is from the line of Rohit Sinha from Sunidhi Securities. Please go ahead.
Yeah. Thank you for taking my question, sir. Sir, as per the presentation, you have mentioned that we reiterated 25-30% kind of growth for FY22. So just wanted to know how we should see this number now, as in the 9 months we are already at a much higher top line growth, and also taking into account the rise in product prices in last 1 year.
Yeah, I know. So we already crossed 9 months EBITDA. Because top line sometimes becomes difficult, as a percentage. So more guidance will be on EBITDA and PBT and PAT levels. So we already crossed 9 months. So on that basis, I think we are maintaining around 25-35% growth rate.
So it would be any reason on that, or it still remain there?
No, basically 9 months we already reached previous year's 12-month number on EBITDA and PBT. And the top line growth is substantially more, but its critical guidance is more on your EBITDA and PBT levels.
Okay. And sir, on this compensation side, I mean, as we have received all money, so just wanted to know what kind of cost was included in this as at the EBIT level we are taking from a 611 crore number. And as you have earlier guided that this facility would be used to secure orders for other customers. So just wanted to know how much revenue we are generating from that particular project, or how many customers we have secured post this deal cancellation.
Yeah, we have forex and related hedging costs to be deducted out of that, and certain commissions. And regarding, we already started the product export of these products from this site, and we'll be doing both domestic as well as export sales going forward from this site. We already identified customers, and qualification of the product also has been done with few customers.
Okay. So just wanted to know the kind of investment we have made in this thing. So any number in terms of revenue from what we are invested in this project?
Yeah, we are looking at, in a couple of years reaching our targeted volumes. We should generate maybe about 400 crore plus revenue.
Okay. And one last question. As you were saying that in pharma, we see growth driven by regulated market growth. So just wanted to know how would be the margin in these business, as I would believe it is less likely to have higher margin in a regulated business.
Yeah, basically in the pharma, we are as we have expanded our capacity, in this quarter, which will be coming online. There are several products where we are unable to meet the customers' demand, so those demands will be picked up. And also, as we are operating in steroid as well as anti-cancer chemistry APIs. So there, overall the number of players, other players who are offering these kind of products are limited. So there we anticipate reasonable margins to sustain for future. So we are getting newer approvals every year for these products also.
Okay. So I mean, the overall margin profile would be better from these level what we are currently.
Yeah. So we would like to maintain this 18-20% percentage, EBIT number for us.
Okay. That's it from my side. Thank you.
Thank you. The next question is from the line of Rohan Gupta from Edelweiss. Please go ahead.
Yeah, hi sir. Good evening. Sir, two questions. Sir, first is on this, because of this nitric acid shortage, what could have been the revenue loss, if you can just quantify? Hi, sir. Am I audible?
Yeah. Yes. I think that absolute quantification we have not done like that, but still maybe around 50 crores can be the kind of number. Yeah.
Okay. And you mentioned that the availability, the shortage still remains there, so probably that may continue to have impact on our even current quarter number as well, and because of this nitric acid shortage.
Yes. It will be some impact in Q4 also will be there.
And sir, you also mentioned that there is a definitely lag of close to month to quarter, and we have seen a very sharp increase in crude prices even in the current quarter. So do we expect that, though we are passing it on, but that may have some delays, or is there any cap you see that there will be acceptance up to a level of only from the customers, and after a level that it can start affecting your demand because the end user industry may not be in a position to absorb that price increase? Did we hit that kind of level because crude close to at $90 to $100 may have put a lot of pressure on the end product pricing? So how do you see that the acceptance from the customer, and can it have a margin pressure for us?
Yeah, most of the products which are made from our product downstream, some of them are agrochemicals and polymers and paints and all that. So impact of this, by the time the finished product is made and put it to the customer, all the marketing costs and also everything get loaded. So price at the hand of the customer, this increase in crude oil and our intermediate price is virtually not significant to really impact the demand. Some commodity plastic like polypropylene, polyethylene, PVC, where the immediate lead goes to the end user, and there you sometimes you see that the pushback on the demand with the base polymer prices increases. But in our range of product, generally crude at 120 or crude at 60 is not going to impact the demand.
Okay, so there is absolutely no problem from the customer end as far as the demand is concerned.
No. It will not, because there the ultimate products are $5, $10, $15 kind of products. Maybe at the customer end it may be still higher prices. So these variations generally gets accepted from the demand point of view.
And so on the product which got terminated from the customer and this dicamba derivative intermediates which you're making, so you mentioned roughly 400 crore kind of sales you are expecting to achieve. Didn't mention any timeline. So by when you think that we'll be able to ramp up?
By FY24. Yeah.
And sir, any idea that any guidance that what is the percentage utilization of this plant right now and what it can be in 23 and next year?
Yeah, this year, we have just started giving a trial, this qualification quantity and all has been started. And FY23, I think it's still difficult to give. I think in our Q4 call, we should be able to guide more on FY23 volume target for that product.
Okay. So can you also give us some financial figures like what is our current debt number for the year end, and what is our cash position, and also in terms of cash accounting from the fees which we have got, I mean from the customer, that how much cash we have got in the current year?
Yeah, Chetan, you can take that. Right?
So as regards the accounting for the fees, we had a advance of 25 million and the balance would be coming up in the current quarter. So that will be fully settled in the current year itself. And Rohan, could you just repeat the question once again? Hello?
Yeah, you wanted to know the overall debt level.
Yeah, the debt levels are almost at 2,700 crores as of the quarter end.
Thank you. The next question is from the line of Abhijit Akela from IIFL Securities. Please go ahead.
Good evening. Yeah, thank you so much, sir, for taking my questions. First, just wanted to clarify on the adjusted PAT excluding the termination fee. Is it 242 crores? Was that the right number I got?
So that would be the PBT, if I'm not mistaken, 247.
Yeah, it's a PBT.
The tax will be at a company level, so something we'll have to look at it on a consolidated basis only.
Okay, got it. So about the same 18-20% tax rate on this. Understood. Besides the 631 crore termination fee, would we have booked another, $5-7 million this quarter as well as part of the usual accrual? So if you could just give us that number as well.
It's a $6.5 million, right?
Yeah, that's around 6.5. That's the last component for the quarter because the contract gets over.
Okay, understood. And on the project, you mentioned that 400 crores is what we are expecting to generate from it in the next couple of years. If I remember correctly, the original project's revenue projection was also 400 crores a year. So essentially, in terms of realizations and margins, it seems to be in the same ballpark as the original contract. Is that how we should interpret that?
Yeah, I think it'll be both a similar order. It will not be exactly same, but I think the margin may be a little lesser. But top line, because the prices have increased in general over a period of time. So raw material prices have increased. So at the constant top line, some margin will be a little less than originally forecast.
Okay, fair enough. One last thing, and I'll come back in the queue. Regarding the demerger, how much of the debt will be transferred to Aarti Pharma Labs? Would you have a sense of what that might be?
So we'll have to actually look at the component when the actual order comes in. So as on the appointed date, which was like 1st of July, the debt was to the magnitude of around 600 to 650 odd crores. I don't remember the exact number, but around that number of debt would have gone. And plus there were some cash balances also. So component of cash balance would have also go over there. But anyway, these numbers will have to be seen as on the effective date when the NCLT approvals comes in and what are the actual numbers at that point of time.
Okay, this is for the pharma business, you're saying?
Yeah.
Okay, got it. Understood. Thank you so much. Wish you all the best.
The next question is from the line of Amar Maurya from Alpha Advisors. Please go ahead.
Yeah. Hello. Hi, sir. Thanks a lot for the opportunity. Sir, firstly on this volumes which you had highlighted, you said NCB volume was 18,500, correct?
Yeah.
And what was the PDA volume?
The PDA volume was around 495, close to 500.
Close to 500. Okay. So, and then hydrogenation 2785, correct?
No, that was 2878.
2878. And nitration, nitrotoluene?
That was 3630.
3630. Okay. And sir, if you can also help me broadly, what would be our DCB, MCB and TCB volume? Chlorination, the whole volume?
I don't have that number right now. Probably we'll have to check on that.
Okay. And just to understand, I think PDA and NCB, we both this capacity got expanded in the second quarter, correct?
No.
There was no expansion of PDA recently.
Yeah.
Okay, because
expansion was a chlorobenzene plant.
Yeah. So nitrochlorobenzene plant got expanded, right?
No,
not yet.
Facility.
Okay, so still that because last time when I discussed, I think around 1,200 crores kind of a working capital, we were looking at NCB 150 crore, USFDA plant of around 400 crores, and two dedicated projects something around 300 crores. So I just wanted to understand that NCB plant got commissioned or it is still in the working capital?
It is yet to be commissioned.
Okay, and that same is the case with that USFDA plant also?
Yeah. But that number wasn't 400 crores. It could be 100 plus crores something.
Because I think you said that something we had bought the land of around 200 crores and 200 crores we are implementing for the expansion, something like that.
No, it was not 200 crore land is not possible. I think.
Okay. So.
I guess, Amar, you got a bit confused. So in the pharma, we've got the land in Gujarat, and over there the project which is going to come up would be of the magnitude of 350 to 500 crores.
350 to 500 crore. Okay.
Yeah, but that is something which is going to come up. It's not currently part of the WIP component.
Okay. And sir, now as you said that out of 1300 crore capex, 922 mota-moti got capitalized or mota-moti got invested, and it could be sitting in the WIP. And you also guided that something around 1500 crore would be invested in 22-23. So what would be that capex, sir, now?
So now all the new projects, what we are saying, new product lines, that construction will start in FY22-23, with FY23.
Okay.
At, near location. So there, from April onwards, we'll have construction of the UMPP plants, what we are guided, as well as some dedicated chemistry. Construction will start in FY23.
Okay. And on top of this, sir, we had also guided for something around 24 to 27, 350 crore capex, right? Yeah, 3,500 crore capex.
So overall, we had guided 4,500 to 5,000 crores in over 3-year period, and out of that, around 1,500 were for the existing ongoing projects, and around 3,000 to 3,500 for the new, more or less a greenfield kind of a project. So that's how the guidance was there. Yeah.
So, sir, these greenfield projects which are going to come, I believe the chemistry would be either toluene or benzene, right? So would this be like a kind of a, when you say high value, what kind of products which will be this, and what kind of profitability you can see from these products? And if you can specify, what kind of products this will be, like this 3,500 crores, the capex which we talk about.
Yeah, this a lot of chemistry will be added. Starting will be with toluene and benzene, but it may be 2, 3, 4, 5, 6 steps will be added. That's how sales to asset turnover will be less, and EBITDA margin will be higher. And most of the products will be both on, it will be multi-end use. It will have for pharma, as well as on a dyes and pigment side, as well as it will have import substitution, as well as export driven, where customer want to diversify the source of China.
Okay. So, sir, if I can squeeze one more, broadly, I believe, as you said, you are looking for export as well as for the import substitution for this 3,500 crore capex, which we are doing. Yes. So, let's say, how big this market would be in terms of the value today, and what much of the market you can address, let's say in India, what would be the import of this value, and what would be the export size, if you can give some color on that.
Yeah, the chlorotoluene range, I think already about 1,500 crore import is taking place in India. In generally, we count, the product what will be made. Normally, 60 to 70% of the market share of imports can be taken up in general. So that is broadly, we look at a market share target for import substitution.
Okay. So fine, sir, I'll take offline. Probably, it will take too much of time. I'll take offline, sir. Sure.
Thank you. The next question is from the line of Vishnu Kumar from Spark Capital. Please go ahead.
Good evening, sir, and thanks for your time. So just wanted to understand the projects that will get commissioned in 23 and 24. If I'm not too wrong, one is a second long-term project, which is saying will get commissioned in FY23. Third long-term contract, when will we get commissioned, sir?
So I guess the second one would get... Sorry, sir, go ahead, sir.
Yeah, second one, we have started this commissioning trials, and we expect the product to come out in Q4 for the second one. And the third contract will be targeting to commission maybe toward the end of Q1 or Q2 of FY23, as far as those long-term contracts are concerned.
Okay. So, what are the projects?
Just a clarification, the second one you are targeting Q23, it is not FY23, it is FY22.
Sure, the second one, yeah.
Could you repeat that?
Yeah, the second one you said that you are looking at FY23. It is not FY23.
Okay.
As Mr. Gogri said that it is under commissioning, so we are targeting to commission it in Q4 FY22.
Understood. So this second contract, what is the utilization levels that we are expecting? Because I understand it's a 1.5 billion for 20 years. So should we take it as 75 million run rate, and when is this likely to be achieved?
So basically, so we will see a sharp ramp up from the first year itself. That so in a couple of years, I think we should be able to reach full capacity.
Okay. And second point is that, if I'm not wrong, sir, this capex is completely funded by the supplier. So I believe the margins in this should be, if I go back to the conversation, it would be much lower than the company level. Is that a right understanding?
Yeah.
Okay, got it. And when we look at the third contract, again, 125 million, could that be the run rate, and what is the margin expectation on this particular contract?
Yeah, I think that was around, I don't recollect, maybe 35%, 35%.
So the margin was in the range of around 35% kind of stuff. And
this is an EBITDA, sir?
Yeah, at EBITDA level, yeah.
Okay. Got it. So this ramp up you will see pretty quickly, or what should be the ideal number that we should consider? This contract, if I'm not wrong, again is about a 125 million for 10 years.
Yeah, that ramp up also by FY24 we expect both of that to be running fully.
Okay, got it, sir. Sir, any other projects that will get commissioned or rather you will see ramp up in 23-24, or something that gets commissioned in 23-24, like NCB expansion which you spoke about, or the acid unit? Indicatively, what revenue run rate should we expect in some of these projects that is coming up?
Yeah, that's what we are guided. By FY24, we virtually expect substantial ramp up of this contract, as well as nitrochlorobenzene, chlorobenzene and all. And that our guidance was around 1.7 to 2 times the top line, as well as EBITDA and PAT over FY21 numbers. So those kind of things by FY24 we should be able to achieve.
Okay. And just to understand, sir, on the volume growth front, I know we have steep revenue growth partly because of commodity. How would have been volume growth this time, this quarter? Be it exports or domestic, any rough indication that you could help us with?
Yeah, YOY maybe around 25% because this values are 50% plus as far as specialty chemical is concerned. Volume growth may be around 25. We'll have to see the exact number.
Okay. So was there any disruption or rather a benefit to us because at the export market, because Chinese companies were not supplying, given we understand many of them are coming back post the Winter Olympics, which is currently on. Do you see some element of supplies are in the export market, they are going to come back again? Any comments on this?
No, we are not seeing that kind of a thing. No.
The next question is from the line of Kumar Saumya from Ambit Capital. Please go ahead.
Good afternoon. So my first question is regarding the receipt of the termination fee. So apart from this 630 crore that we received in the current quarter, was there a remaining amount that we received in the first half of the year?
My question was not very clear. Yeah.
Sir, we received around 630 crores in this quarter. So in the first half, what we received from this fees, like any penalty fees that we received in the first half?
Yeah, first quarter was 4.5 million, and second quarter was about 7 million. And third quarter our provision is about 6.5 in addition to this termination fee. Okay. So that was the number. Chetan, you will have a number in crores also, right?
Yeah. This is $1 million.
Yeah.
Okay, sir. Thank you. That's okay, sir. Thank you.
Okay.
Thank you. The next question is from the line of Aditya Khaitan from Stewart & Mackertich. Please go ahead.
Hello, sir, and thanks for the opportunity. Sir, first question is again on the 4,500 crore capex which we are targeting. Out of that, the newer segment capex is around 3,000 to around 3,500 crore. You had said to an earlier participant that you are targeting more towards the benzene and toluene chain only. So if you can just break up into segments like, so first segment is the chlorotoluene. Apart from that, which are the segments which we are particularly so targeting? If you can break up this number into some of the segments.
It will be further evaluated downstream products from dichlorobenzene chain as well as nitrochlorobenzene chain also, in addition to the entire chlorotoluene chain. And some nitrotoluene downstream also will be added. So we have currently we have got 3 benzene and 1 toluene chain where we make the base product also. So all evaluated downstream from all those 4 will be added. And the chlorotoluene will be adding the base chemistry of toluene chlorination as well as the downstream.
Okay. Sir, on the crude oil prices, and now definitely with this level of crude prices, as you had said earlier also that Aarti is comfortable to pass on at any crude oil level. But considering like we are into an upward surge of crude oil prices only now, so so just to get a hypothetical idea, out of 100 customers, definitely so 70-80 could absorb, but there would be some amount of 10-20% of customers which might reject. So are you witnessing some sort of so that kind of a scenario right now?
No. As I mentioned earlier, the ultimate product which are made, which is consumed by the end customers, which will be in the going into the agrochemical or some pharmaceutical and all those values are very high. So these intermediates, I would say even $130-$140 crude will not impact demand at all.
Okay, sir. Thank you, sir. That's it.
Thank you. The next question is from the line of Nitin Tiwari from Yes Securities. Please go ahead.
Good evening, sir. Thanks for the opportunity. So my questions are just a couple of clarificatory questions. So the compensation payment that you have mentioned in this quarter's result, is that is something we have received or that has accrued to us and we are yet to receive?
Hello? Yeah. So we've got something like around close to 180 plus crores already with us as an advance, and balance will come in the current quarter.
Right. So you mentioned about the receipts in the previous quarters as well. I missed out on that number. So it was about $7 million and $6.5 million, something around that. So would you please repeat those numbers for the first quarter?
So basically in the first quarter we had provided for around 4.5 million. In the second quarter it was 7, and the third quarter of 6.5.
Right. So so basically we are looking at, out of this 18 million, we have received about 180 crores of payment, and rest would be pending. That's what you're saying?
Yeah.
Okay. Got it. And sir, also regarding the second and the third long-term contract, so if I heard you right, basically the commissioning of second long-term contract is at the end of fourth quarter FY22.
Yeah.
And the third one is at the end of quarter 1 or quarter 2 of FY23. Right?
Yeah, it should start in Q1, Q2 FY23 kind of stuff.
Correct. So you also mentioned about an EBITDA range for the third contract. So could you please also give a sort of a EBITDA range for the second contract as well, and what would be the annual run rate of revenue in that contract, if you can help me with that?
So in the second contract, the annual run rate, which we had disclosed earlier when the contract was executed, was in the range of around 500 crores. As Mr. Gogri shared in the call, it will have a faster ramp up and might take a couple of years for us to reach to that level. The EBITDA, because there's no interest component or other stuff which is charged, so the EBITDA should be relatively lower. We'll have to see the exact number, but it should be in the magnitude of around 14-15% or so. We'll still have to rework it because a lot of numbers, including the raw material prices and a couple of other input costs, have gone through or gone changed. So we'll have to rework it, but it should be in that 12-15% range kind of stuff.
The name is about 30 to 35% in the third contract. That's what we are looking at in terms of EBITDA, right?
Yeah, around that kind of stuff. So
right.
These are basis the pricing which was available at that point of time when the contract was signed. So some of those basis the input cost which has gone up, there could be some change on it, but I don't see a substantial. So on an absolute basis, the EBITDA guidances would continue to be there, what was guided earlier.
Got it. And also, if you can just help us, which segments these two contracts are targeted at? I mean, are they catering to agrochemicals or to dyes or to which end market segment? If you can help us with that.
Basically, specialty chemicals. We will not be able to guide anything further on that.
Right. So, and I was just wondering because as in the case of first contract, dicamba I think was meant for agrochemical production, right?
Yeah.
But over here we've got certain restrictions, so we can't guide beyond what it is there in specialty chemicals.
Understood. Great. So that is all from my end. Thank you so much for answering the questions.
Thank you. The next question is from the line of Rohit Nagraj from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. Just to again delve on the total income from the long-term contract. What was the amount in rupees crores for FY21 and for 9 months FY22? And obviously the termination fee is 631.
So this is in respect of the first long-term contract?
Right.
So you're talking in terms of the revenue which is being generated,
or? No. So I understand during FY21 we were getting close to about $5 million each quarter.
That was around 140 odd crores roughly for the FY21.
Right. And if I add this $18 million for 9 months, it's close to about 135 crores. And
that kind of stuff. And another 630 kind of stuff.
So total about 900 crores is what we have received.
Broadly, plus minus some 10-20 crores here there.
Correct. Okay. The second question is in terms of the long-term contracts. So we have given a range of revenue, growth for FY24 as well as FY27. So by FY24, how much percentage of our revenues might be coming from the long-term contract? And similarly on FY27, given the visibility that currently we have.
Yeah, overall, long-term contract percentage increase with these two new contracts also, and some more contracts are also being discussed. But our non-contractual sales will also increase. So overall, we have not done any specific bifurcation between this long term. But in general, most of our products, we have very good visibility with the customer about their next 2 years demand and how they are going to grow and how much they will be buying from us in that sense. But this long-term contract percentage is increasing. Yeah.
Right. So got it. Just a small clarification on long-term contracts. So whenever we are discussing new long-term contracts, the project execution period is say 2 to 3 years, or it is now lesser than that, given that we already have a particular asset size and the projects which are currently ongoing?
It depends. If there is a greenfield, it's more time. If it is a brownfield, then obviously it is faster because we've got a lot of infrastructure in place. So it depends on that, and also the complexity of the project and the total capex involved. So it will be anything between 1.5 to 3 years kind of number, depending on the size of the project and whether it's a greenfield or brownfield.
Right. So just one clarification on R&D front. Currently, what is the strength? What is the number of PhDs and technology people who are into R&D?
I guess the headcount, we'll have to do the recent headcount, but it will be upwards of 400.
Okay, got it. Thank you so much and best of luck.
Thank you. The next question is from the line of Naushad Chaudhary from Aditya Birla Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just one clarification I wanted. So typically in long-term contracts, that means there is a commitment from our side in terms of our project commissioning and supply on time. And at the same time, there is a commitment from the client side on the volume of it, right? If I am understanding it correctly.
Yeah.
But if I see the commissioning timeline of both of our contracts, second and third long-term contracts, there has been a substantial delay. The second long-term contract, initially it was expected to come by 1Q21. It's been around 2 years delay in this contract. And similarly, around 1.5 year delay in third long-term contract. So just wanted to understand who is dealing, what is the reason and for this delay, and the client is not pushing us to to get it on time or get it quickly, or is this an indication that the ramp up of these two contracts could be slower than expectation and there's not much demand of the product from the client side as of now?
Yeah, basically, this delay was mainly because of COVID, with the 2 waves, and that was a global event. So actually, this second contract was already reset by 1 year because of the entire COVID-related thing happening in that. So we are in constant touch with our customers regarding the delay which was happening on that front. But on the ramp-up side, we don't see any issues. I think from their side, the demand, they don't see any challenges going forward.
Okay. So the annual revenue run rate which is expected, can we expect it to come within a year or two, the full utilization of both the contracts once it gets commissioned?
Yeah. By FY24, I think both of them will reach almost full run rate.
Okay. Thank you so much.
Thank you. The next question is from the line of Rohan Gupta from Edelweiss. Please go ahead.
Yeah, hi sir. Sir, thanks for the follow-up, and sorry, got dropped out in the previous question. Sir, another few questions on, especially on the capital employed in a chemical business and even in the pharma. Gross block has gone up, investment has gone up significantly, which I believe is a combination of both capex as well as Sir, it seems, looking at the numbers, like there has been close to 1,800 crore rupees in asset increase from Q4 to Q3, while liabilities has gone up only from 200 crore. So just wanted to understand that because of the high input prices, the debtors has gone up significantly in inventories also, but are we not getting enough lineup from payables, and is there any significant increase in working capital that is going to affect our interest cost in the current scenario?
So Rohan, just to address the question, probably again the increase of 1,800 crores, 900 is on the capital spend which is there. There will be 600 crore related to the termination, which is also shown as receivable and part of capital employed. So, and the resultant would be on the working capital side. So I guess that kind of explains or summarizes a major part of your thing.
So even the 600 crore rupees is also included.
Yeah, because we still have to receive a substantial part, so there will be a good part of that also as a part of capital employed, right?
Okay. Sir, as a part of this termination contract arrangement, the balance money was supposed to come by end of FY22. So this balance 600 crore rupees entire money, you think that will come in the current quarter?
Yeah.
Yes. Okay. And that will lead to total money received from this contract termination is 980 crore, because that actual was $140 million, right?
No. So we had given a guidance that it could be in the range of 120 to 130 million dollars. So I guess the numbers are within the guidance which you had given in June 2020.
Okay. Fine, sir. Sir, second question is on this, the product which like the derivative only. You mentioned that we can achieve a revenue potential of almost 400 crore, which was actually a full revenue potential from this contract when we did it with the Monsanto, and was supposed to have a 40% kind of margins. Do you see that at a full potential when you are selling this product to outside, will you still have a 40% kind of margins in that segment, or it will be in that product, or it will be much lower than that?
No, it will be lower, very much lower, I would say.
Okay, so we may achieve revenues, but definitely in terms of margin profile, it will be much lower.
No, not much lower. It will be little bit lower, I would say, but not a 40%. It will be more towards between 30 to 40% range. Within that range, it will fall.
Okay. Sir, we are almost end of the year and having invested close to 950 crore in capex by Q3. Though the still range for the current year still looks pretty large in terms of from 1200 to 1500 crore total capex for the current year. I believe only a couple of months left for this year also. So you may have a fair amount of visibility that how much will be capex for the current year, and are there spillover you are expecting that are any delays in the capex for the current year?
Actually, we have recorrected in our statement. Now we have said 1200 to 1300 crores. Right, Chetan?
Yeah. So Ron, probably missed out when you were dropped off. So for the current year, it should be in the range of 1200 to 1300 crore.
Oh, okay. Because I was just referring the presentation where you mentioned 1200 to 1500 crore.
Yeah, that was the annual guidance, and now but the 9 months are over, so we are now looking at around 1200 to 1300.
So in that context, sir, can we be concrete about next year capex plan of amount wise?
No, next year we have to still work out in detail regarding the cash flow. Overall, the 3 year which was guidance was there, 4,500 to 5,000. That is for sure. I think that will be.
Fair enough, sir. Sir, when you say that 85% utilization is specialty chemical for the current quarter, can you just say that, can you give what was the gross block number was considered in that?
Rohan, I'll have to check that number. I don't have it right now handy with me.
Okay, but definitely entire 950 crore invested in the current year would not have been part of this 85% utilization.
A substantial part of this is in capital WIP. Those projects are yet to commission.
Correct. Okay. Fine. So thank you very much.
Thank you. The next question is from the line of Bob from Falcon. Please go ahead.
Yeah, hello. I wanted to ask whether you see any new competition coming up given the growth in this sector, in India especially?
Yeah, we have a very wide product range, and we have some competitors in India as well as in other countries. But overall, we don't see any significant increase in competition.
So you haven't had other chemical manufacturers getting into benzene derivatives recently?
Yeah, no, not yet. No.
Okay, right. Thank you.
Thank you. Ladies and gentlemen, we take the last question from the line of Surya Patra from Phillip Capital. Please go ahead.
Yeah, just one clarification, sir. You mentioned that under your R&D projects, some around 40 odd products are there in the chemical pipeline and 25 odd in pharma. Can you elaborate on that front a bit?
Yeah, for 50 plus in pharma, yeah.
So that number could be, I'm saying, on the pipeline front, if you can just give some clarity on that.
Yeah, so that's what we said, no? The chlorotoluene and its downstream, as well as the downstream of nitrochloro, dichlorobenzene, nitrotoluene, value-added downstreams. They are the product range.
You had earlier mentioned about while setting up the new R&D plant in Mumbai, you had mentioned about few new areas. So,
no, the chemistry-wise, there are a lot of new chemistries. These are the products downstream, but the chemistry will be having a photochlorination, amoxidation, then AHF chlorination, Grignard reaction, Ball-Siemens reaction. So a lot of new chemistry will come in.
Okay. So in terms of application, majorly how would that be distributed?
It will be both, agro as well as the pharma product going into starters and all, and some going in dyes and pigment side also. So we have a very wide range of application. But these three sectors will be major: agro, pharma, some dyes, pigment, and some other sectors.
Okay. In regards to in the pharma manufacturing side, how integrated that we would be post this pipeline?
Yeah, so basically in pharma, we are largely up to N-5 stage on most of the APIs that we manufacture. We are doing more or less in our in-house manufacturing, except the steroid range of products. And whereas in certain products like sitagliptin, etc., we will be vertical from benzene straight away till the final sitagliptin. So that is one example. Or there could be similar few examples of few APIs, but that value in terms of turnover may not be significant. But as a practice, generally we try to do at least 5 to 7 stages in-house in pharma, non-steroidal products.
Okay. So then how the business model of Aarti drugs will be different from this? So because that is also API and looking for kind of for integrated.
Yeah. So basically, what we are doing in Aarti Industries is largely specialized chemistry of steroids, anti-cancer, as well as the anti-hypertensive and lifestyle medicines, which are higher value and lower volume products that we are targeting.
Okay.
And we don't do generally the products which are below $100 a kg. Whereas in Aarti drug, largely we are into ciprofloxacins and anti-infective, pain management.
Large volume old products.
Yeah. So these are all older products where the values of certain products are above $100, but largely under $100. But there are some products which go up to $300-400 also, but largely in that space. So that is largely Aarti drugs is focused on ROW market, whereas here in Aarti Industries we are focused more on the regulated markets, as well as we are also selling intermediates of these APIs to all the generic manufacturers who are like companies like Dr. Reddy's or Mylan's or Zydus or Alembics, and they buy intermediates for their regulatory requirements.
Okay. Sure.
Yeah.
Thank you, sir.
Apart from that, we are also having CDMO business, also in pharma, so which is a different business, which Aarti doesn't.
Then in terms of the facilities, also in terms of manufacturing facility, so it is entirely batch processed kind of model.
We have fully flexible manufacturing where we can do a multi-purpose plants where we can do any product which fits that manufacturing location. So it's a facility which is we can change the product and go to different product if the particular product suppose market has gone down due to life cycle, etc. So then we can always substitute a new product. Whereas in case of Aarti drugs, that is little bit less possible, but of course doable.
Sure.
Yeah.
Okay. Yeah. Thank you, sir. That is very easy.
Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
Yeah, it has been a pleasure interacting with you over the call. Before we close the call, let me reiterate that with the execution of our planned growth objective, we look forward to driving strong value for all stakeholders associated with Aarti Industries. We thank you for taking time out and engaging with us today. We value your continued interest and support. If you have any further questions and would like to know more about the company, kindly reach our investor relations desk. Thank you.
Thank you very much, sir. Ladies and gentlemen, on behalf of Aarti Industries, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.